It's not just the rise in interest rates, it's the speed. We saw the biggest increase in rates yesterday since the 2016 election. So do markets start to panic when we get to that point where we cross 2% and all of a sudden, oh no, that's a cap on valuation?
Well, short answer is I don't think so. I mean, certainly if rates keep climbing, it's going to be a threat to some of those bond substitute sectors like REITs and utilities,
and we're starting to see
we
that
were overweight during the summer, and now we're back to equal weight. But one, I don't think the 10-year yield is going to materially exceed 2%, not in the short term and not for the rest of the cycle, which I think has several years. I think inflation stays low, and I think the appropriate real interest rate across the curve is 0 for the United States. So I think interest rates will be not a threat to markets. What I also think is that you've got a situation where finally the politics have been a big concern. I thought we'd roll in from the industrial soft patch to the politics. If Bloomberg enters the race and gains some traction, I think a lot of investors would feel better with either one of those outcomes.
Do you think that that's realistic?
Well, I don't know yet. I think it's a real possibility.
You do?
Yeah.
We've just been discussing this all morning.
Well, it's been in the back. I'm a New Yorker. We know about him and the company. We've been wondering if he would be really in it and put money to it. Look, I would feel a lot better about knowing that those were the binary outcome rather than a possible Elizabeth Warren. So look, also, by the way, people are looking for catch-up trades. I would say go buy healthcare if this is the situation developing on politics. I'd also say if things are de-escalating.
Meaning you think if Warren is weakened, then healthcare is the trade?
Yes. It's good for the market. It's really good for healthcare. By the way, if things are getting better between the U.S. and China, there's still a quarrel. Joe was right. They're in counseling. They're not in the divorce, but there's still a quarrel going on there. If things get better, emerging market Asia is going to do well.
What's on the other side of the Ben Franklin close right now, Santoli? What's the biggest? Is it that next slowdown, we've got no ammo? Is that the biggest thing?
Maybe that's one of the bigger picture ones. I do think, although, look, I think there's ammo. I mean, the Fed is
it's really it is. I hate Goldilocks scenarios because it always goes down from there, but it isn't. Aren't there?
I think it's pretty well balanced right now. Valuations are not particularly attractive for stocks, but they're not out of the range of normal necessarily.
Given all the other good stuff.
And especially if the third quarter, as it looks likely, was sort of the trough for earnings. Third, fourth quarter, it's going to inflect up from there. So you didn't really have a downturn in profitability. You just had the lull. If that's the case, then I think the market has a bias to click higher if there's not a recession right there and there's not a lot of financial stress in the system from something else. Credit markets still wide open. So all that stuff would be favorable. In the short term, tactically, people are going to get too bullish. It's going to overshoot to the upside. You see things like big cap tech and industrials running really hot right now. But that's just short-term tactical stuff.
Do you know anyone on the street, sell side, that got this right? Can you name anyone? That's a good sign.
I think there was a certain premise out there that said, okay, we have this.
You mean go higher into
go higher.
JP Morgan.
Yeah, I think our friend Tony Dwyer has been saying this is kind of a mid-90s type of free play. Jim Paulson has also got it right. In fact, Jim got the downturn last year.
Right.
Correct.
There's been some really well-known names that are, they just hoping. I don't know, we forget where their targets were, and they can, maybe on the weekend raise the targets. No, it's not 27.50. It's.
I don't think people get paid for the target. You get paid to have an.
Obviously, they get paid.
Plausible.
Nobody would get paid that.
Right.
Story for what
how to present it where you really can't pin them down. I think is why they get paid for. But that's why the buy side, you gotta, those guys get fired, right? Eventually, or they run out of clients and write for real money. I mean, that's what.
Or they get made obsolete by machines.
Try and live on whatever.
What
do you make of writing for real money? Not much. Anyway, it's weird, isn't it?
It's a tough market, and I think one of the lessons over the past decade, if not the past several months, don't make big bets. Let's stay invested and diversified, and that's what we're doing. We always had a little bit of a small budget in our risk-taking for tactical calls. That didn't go exactly right during the summer. I still think the weak parts are manufacturing, the commodity complex. Oil's not doing so well given this big risk-on rally. And I think you are going to have flat profits out of the S&P for another few quarters. And the downside risks are at these value industrial-oriented businesses.